Hello, I'm Finola from RaaS, and we're focusing today on Intellectual Property Services Group, QANTM IP, ASX ticker QIP. And joining me to discuss the company's FY23 results and strategy is CEO Craig Dower and CFO Brenton Lockhart. Welcome, Craig and Brenton. And Craig's got a little bit of an injury here, but so we're very pleased to have you join us today.
Great. Thank you, Finola. Nice to be here.
Now, Craig, a quick reminder about QANTM IP's business. It has a broad services portfolio covering patents, trademarks, designs, litigation services as it relates to intellectual property, and it's developed a SaaS-based platform for trademarks. Have I missed anything?
No, that's about it. We're a broad-based intellectual property services firm. Everything that we do is related to IP in some form. And we tackle it from multiple perspectives, as you say. Patents is the sort of engine room of our business. It's about 70% of our revenue. About 20% of our revenue is trademarks, and about sort of 10 to 12% in any year is legal and litigation services, which can include patent litigation or a whole range of things relating to IP infringement, either happening to our clients or we're acting on behalf of our clients. We have three main brands within our business: Davies, Collison Cave, which is a long-standing Australian IP firm dating back to, I think, about 1877. I think DCC filed the first ever trademark in Australia, so they've been around for a long time. And they are a full-service IP firm with patents, trademarks, law, and also advisory services. FPA Patent Attorneys, which used to be part of Freehills, the global firm now known as Herbert Smith Freehills, and they spun out of Freehills probably about a decade ago. Brenton used to be the finance director there, and became part of the QANTM Group at the time of listing in 2016. And then recently we acquired a business in New Zealand called Sortify, which is, as you said, a trademark filing platform with an AI core at the end of it, at the center of it, and a software development team that is very well versed in machine language and artificial intelligence. We have about 370 people spread across 5 countries today: Hong Kong, Malaysia, Singapore, Australia, and New Zealand. And a big part of our strategic focus is to expand that footprint, particularly into Asia. And I can talk a little bit more about why Asia is important from an IP perspective a bit further on.
And QANTM IP delivered its best ever results since listing, with service charges up 7.4% to 103.8 million, underlying EBITDA increasing 8.2% to 28.5 million, and underlying NPAT up 14.5% to 14.7 million. How much of the result was attributable to the restructuring you've undertaken within the business as opposed to growth in market share in both patents and trademarks?
It's a bit of a mix. We, as you say, just over 7% revenue growth, just over 8% earnings growth. So earnings growing faster than revenue, which is good. That hasn't been our story for the last few years, because we've been making a number of strategic investments across the business in technology, in our people, and in geographic expansion. Probably about half of our growth was organic last year. We've been very focused on organic growth and growing market share. The market for both patents and trademarks overall was down last year. Trademarks tend to be a bit more of a canary in a coal mine. They respond more rapidly to both economic headwinds and economic tailwinds. So we saw a reasonably substantial decline in the global market for trademarks last year, but our businesses actually grew overall. Sortify was a big part of that. So that's really helpful in helping us understand that with the addition of Sortify to our business, we can grow in a down market. And our patents business grew last year as well, modestly, only 1%, but I think the market was down about 7% or so. So we grew relatively against the market, and we took some market share as well. On the earnings front, Brenton can correct me if I get this wrong, but I think whilst our expenses were up overall about 5%, our employee costs were up 1.6%. And when you look at that, there's a mix of things in there. We actually recruited people last year. We're constantly recruiting and refreshing, and we're bringing in people at various levels of the organisation. We do a lot of recruitment at the entry level, and we train people, and they stay with us for a long time. So we recruited. We gave people pretty substantial pay rises last year, but we also didn't fill many roles on the back of attrition. And we did a bit of a restructure here and there in our corporate team and a couple of parts of the business as well. And so some people find that a little bit counterintuitive. You know, why are we hiring over here and we're, you know, making some redundancies over there? And this is really this sort of whole process of renewal and refresh that takes place as you're growing. And so, so a bit of mix around all of that. Brenton, anything you wanted to add to that?
Yeah, and I think what we saw in particular was where through COVID we looked after our people over a long period of time. In lockdowns, it's not the right time to have a bit of a look at the business and see where there might be pockets of underutilization or we're not growing. So we looked after and put a lot of investment in the people, and then it was the right time, particularly as we're moving through our tech modernisation simplification program, to have a look and see where we could improve efficiencies.
And I would just add one thing to that as well, if I may. Finola was thinking whilst Brenton was talking. Brenton took on the role of CFO just over a year ago, but he had been with the group for 4 or 5 years before that, both as the Director of Finance within FPA, and then he sort of double-hatted and was our Head of M&A for a while. So Brenton came into the CFO role with a very fresh perspective and set of eyes focused on the opportunity to improve our financial disciplines on a number of fronts. And so we have done that in the last year. And I think Brenton's leadership and the whole finance team, as well as the business leadership as well, have been part of that. And so, you know, we're getting more rigorous around how we set targets, how we track and monitor, how we manage cash collections, all of the sort of usual things that you would expect around financial disciplines, which we had in place. I don't want to paint a picture that we had nothing in place, but Brenton's fresh perspective and energy has really been a trigger for us getting even stronger around fiscal disciplines in the last year.
That's a nice segue into my next question, actually, for Brenton. The company saw an acceleration in the second half of FY23, with the EBITDA margin growing by more than 100 basis points, Brenton, to 28.4%. QANTM IP has a stated goal to bring EBITDA margins to the low 30%. Could we see the pace of margin improvement maintained into FY24? And is your goal achievable by FY25?
Yeah, I think the way we see it at the minute is it's more going to be a 2 to 3 year journey. It is entirely possible that we do hit it in FY25, but at this point in time, we're seeing it as 2 to 3 years. A lot of that big improvement was the restructuring that we did in the first half that flowed through to the second half. So there'll be, again, when we look at our tech modernisation program, we had $1 million that has flown through in the second half. We're expecting another 1 to 2 next year, which will be cumulative 2 to 3, and then 4+ the year after. So it won't be as steep with the half, but we do expect it to continue to improve.
And you invested around $3 million in the SaaS platform in FY23. Can we expect to see this investment maintained this financial year? And at what point do you expect to get an ROI on that investment? And what does that look like?
Yeah, we've already started to see some of those benefits come through. So in FY23, we had $1 million that has flown through, particularly in the second half. For FY24, we're expecting another $1 to $2 million in benefits to flow through, which will be cumulative 2 to 3, and beyond that, we're expecting again $4+ million in benefits. The spend to date, we're expecting to spend another 3.4 in FY24, which will bring our total spend up to $9.9 million. The whole program overall, when we said initially, was 8 to 10 million spend, $4+ million in benefits. We've already seen 1 million come through last year, as I touched on before, another 1 to 2 this year, and in the year after 4+. So the benefits are already starting to flow through currently, and we are expecting more to come.
And Craig, QANTM IP has a strategy of both growing organically and through acquisitions. Are there attractive opportunities presenting themselves in this current environment?
Yeah, it feels a little bit like Groundhog Day when we talk about M&A, because we've been saying the same thing now for probably 2 or 3 reporting periods, and that is that we are looking at a number of small to medium-sized opportunities. we want to make sure that the opportunities that we're focusing on are able to be executed within our current balance sheet and loan facilities. And Brenton, I think our current loan facility is about 25 million US dollars.
26.2.
There you go. I was in the ballpark at least. And so, we wouldn't be doing a capital raise or anything like that. So we want to be sensible about it. We've had great engagement with a number of opportunities. We're continuing to have those conversations. We've also walked away from a couple of opportunities as well. We don't want to do a deal just for the sake of doing a deal, and particularly with the rising cost of debt and the potential impact on valuations. We want to make sure we get that right. Cultural fit is critical. Anybody that we're talking to, we want to make sure that they're joining us not because they want to cash out and retire, but because they want to be part of our vision of being, a preeminent firm in Asia. And so that kind of filters out a lot of folks pretty early on. And so we've got 2 or 3 active conversations underway. Again, we would hope that in the next 12 months or so, we'd be able to close one of those. They often get tricky right towards the end when it comes to the gnarly question of valuation. And so, we obviously don't want to overpay, and we want to make sure that we get the cultural fit and the strategic fit right. In the meantime, whilst we continue to do that, and we're not going to take our eyes off that. That is definitely a critical part of our overall strategic thinking. In the meantime, we are continuing to invest in growing organically, and I think that organic growth is a good story. It's built on the back of the great work that our people do in client service delivery every day. But we have improved our processes over the last few years. COVID gave us an opportunity to sort of think more deeply around business development. How do we target specific firms and why? And now that we can travel again, we're getting the opportunity to sort of take some of that thinking and discipline around client account planning and those sorts of things that we developed during COVID, taking them out for a test drive, and they're going well. We had a couple of fairly substantial new client wins in each of FPA and DCC last year. And we're also going deeper into the existing clients that we work with, making sure that where we have potentially multiple practice or multiple technical discipline opportunities that haven't been positioned in the past, that we're doing that and having those conversations as well. So M&A will continue to be important for us, but we want to make sure that anybody that we bring into the fold joins us for the right reasons and is there for the long term.
Well, thank you, Craig and Brenton, for joining me today to discuss Quantum IP's results and strategy. Looking forward to catching up with you through the course of the financial year to check on your progress.